Hi, I'm Chuck Inglefield, founder of Inglefield Retirement Solutions. This is my economic update for the fourth quarter of 2025. This quarter, we're going to do things a little bit differently. As I look back over 2025 and looking forward into 2026, I realized I only need one slide to communicate this period of time for us. I'm sure some of you might be able to relate to this. It's been a little bit of a wild ride this year, and looking from where we are now into the future, there are still a lot of things that are uncertain. My goal is at the end of this discussion, you will feel a lot less like this, maybe have a little bit more clarity about what's going on with the economy and the markets. So the true agenda for today is we're going to talk about four things. The economy. Does anybody actually really know where we are? We'll talk about tariffs, what happens if they stay or what happens if they go based on the Supreme Court's decision. Talk about what the Fed might do in December. Will we get a rate cut or not? And then we'll wrap up with a discussion about stocks. There's a lot of concern about, are we in a bubble or not? First, let's talk about the economy and why it's so difficult to tell where we are in the economy at the moment. And it's because of the government shutdown. When we look back to when the shutdown started to early November, there'd been a lot of data points that would have been released that have not been. So the non-farm payrolls, which really helps us understand a lot about the job market. We've missed two of those reports. Retail sales, which helps us understand what the consumer is doing, and that's 2/3 of the economy. We've missed that. We also missed the report on what was the GDP in the third quarter. So quite a bit out there. And then PCE is inflation. These are things that the Federal Reserve uses to determine what they're going to do. And it's what a lot of market observers and investors do to get an idea of the sentiment and the valuations on stocks. So we are flying a little bit blind at the moment, but let's go forward with what we do have. And the first thing is we've got some information about jobs. This was released by ADP, so this is not a governmental agency that puts this together. And we do have data for October, and it shows that private job growth picked up in the month of October, which is great because we'd seen declines in August and September. So hopefully that is a good indication that we're avoiding more of a slowdown in jobs, which the official government data was pointing to before the shutdown. Also, inflation. We're not getting much data on inflation, but I wanted to point out the trend here. You can see on the far right side of this slide, the trend just shows that it has been creeping up. It's staying stubbornly high at 3%. Technically not really high, but it's above the Fed's 2% target, which will indicate to me that the Federal Reserve might be less likely to drop rates in December because they're still concerned about inflation being a problem. If the job market turns out okay, that'll leave the Fed sort of more comfortable to not drop rates. When the job market gets weak, they do want to drop rates to stimulate economic activity. So we've got competing forces here. Inflation staying a little bit high and the job market showing some weakness, but how much we just don't know yet. I believe that the Fed's just going to sit on the sidelines in December. We've already had 2 rate cuts over the last 2 meetings, and they just don't have enough data right now to, I think, confidently make a move with interest rates. All of that could change because the meeting's in the first week of December, but for now, it looks less likely that we'll see a rate drop. All right, how about GDP? I mentioned that GDP was not released for what happened in the third quarter. So we have the first quarter, which was negative, the second quarter, which was very positive at 3.8%. The third quarter is expected to be somewhere less than 3.8, probably about half that, but we just don't know. And the fourth quarter is probably going to look bad. And the reason it's going to look bad is because of the government shutdown. I think the early estimates on the fourth quarter was it was going to fall somewhere in the 2.5% range. And that's going to be drawn down because of the government shutdown. Estimates say that, frankly, the shutdown is going to pull about 1 to 1.5% off the GDP number for the fourth quarter. So if GDP was weak to begin with, let's say it was only 1%, and the shutdown pulled it down another 1.5%, it's possible you would see a negative number on GDP. I don't think this is an indication of a recession because as these things play out, what tends to happen, the economic activity that didn't happen during the shutdown will start to happen and be made up for, which means the fourth quarter number is going to look weaker than it probably would be. And the first quarter is going to look much stronger than it likely would have been. So this data is going to be quite noisy for the next couple of quarters. So I wouldn't rely on it as much for an indication of where the economy is at the moment. One of the biggest drivers of GDP is consumer spending. So let's take a look at the strength of the U.S. consumer. There's a lot of data on this slide, and I want to focus on the two graphs on the right. Let's zoom in first on the upper right, which is about the household debt service ratio, which is just what percentage of disposable income is dedicated to debt payments for a certain household. And you can see we're at 11.3% here in the third quarter, which is really just back to where it was before the pandemic and lower than it's been really since the 80s. So this does not look like a problem at the moment. So debt payments are definitely within most people's budgets, a reasonable manner. The next graph flows into early delinquencies, and we're looking at auto loans, credit cards, student loans, mortgages. Obviously, the orange line jumps off the chart here. That's the student loans. People stopped paying them, didn't think they were going to have to pay them. And then, of course, it turns out they do have to pay them. And I'm not sure everybody's convinced they do. So they've not been paying those, and you're seeing delinquencies. But the one that I'm really focused on here is credit cards. Because credit cards, and it's this green line, have really risen since the later days of the pandemic. So if you look in 2022 is really when they started to go up, and the delinquencies have gone up. And if you look back to the early 2000s, we're at, outside of the Great Recession in 08, 09, we're at levels that we haven't seen in quite a while. So this could be a canary in the coal mine for consumers. Have they exhausted the money that they had from the stimulus payments and then turn to using their revolving credit or their credit cards to stay afloat? And of course, we know how much groceries are. If you are on the lower end of the income scale, you might have to be using credit cards to buy groceries and such. This is a little bit of a concerning number. Also, auto loans is starting to creep up, and you can see that here. It's still not dramatically higher, but it is definitely getting higher over the last couple of years. So we need to keep a look at these items to see if consumer has run out of steam. We're in an economy where, frankly, the upper incomes and retirees who own investment assets are doing just fine, and they're really carrying the weight of the consumer spending, where the lower income categories are struggling with the rising living costs. And I think that's what's indicated here. So it's not just as simple as our default's up, that means the economy's in trouble. It means part of the consumer spending is in trouble, but frankly, the higher incomes what's really been driving the consumer spending since the stimulus money has really petered out at this point. Now, one thing that's interesting to think about is there was a tax bill passed this year, which will start to show up on people's tax returns next year. So quite a bit of detail in that bill, but essentially, to simplify it maybe too greatly, people are going to get larger returns next year, or if they didn't get a return, they might get a return. That works like a stimulus payment. So if you look at the 3 stimulus payments that happened from the beginning of the pandemic to mid-2021, you can see that's the disposable income line jumped up meaningfully every time there was a stimulus check. And consumer spending really followed suit, not to the same magnitude, but it also prompted consumer spending. So that is a tailwind that's already baked in for 2026 as far as more money in consumers' pockets. So we'll see if it has the same impact as those stimulus payments did. I hope so, because I know a lot of people out there could use that money, frankly, just to keep up with their current debt load or just day-to-day living expenses. That remains to be seen. So consumer spending, still a wild card, which is why I wish we'd had those retail sales numbers, but we'll start to get some of that data, I think, relatively soon. But all of this leads us to think, okay, if the consumer might be weakening, is there a chance that we're going to run into a recession? And the one indicator I use over 2 parts of the economy is the Purchasing Managers Index. And this is for manufacturing, which is about 1/5 of the economy. I use the scale over here on the left. If the blue line is under 50, that means that there is contraction in the manufacturing sector of the economy. And you can see we've been bouncing around 50 for quite a while. So there's not really any convincing data here that says, hey, watch out, there might be a recession on the horizon. 4/5 of the economy is services. And so that's what this index is showing us. And you can see it's slightly above 50, but it has also been right around 50 for some time now. So the PMIs are not showing that a recession is on the horizon. This is a very forward-looking indicator. And based on these, you really can't see anything bad in the immediate future. That said, they're not strong, they're not weak, which means we're a little bit more prone to slowdowns from here. There's not a lot of cushion if things do start to slow. So really be important for us to understand more about what's going on in the economy, especially with consumers and jobs moving forward from here. One other big wild card out there is what's happening with the Supreme Court, who is reviewing the tariffs and whether they will stay in force or not. This particular case made it to the Supreme Court because the lower courts all said no. The current administration has overreached to put these tariffs in place. The consequence here is that if the Supreme Court decides the same, all the tariffs have to come down. And that's going to create a bit of a mess in the short run if that is the case, because the Supreme Court's probably going to indicate whether the money that's been collected so far on tariffs has to be paid back, which would be cumbersome. Or they might just draw the line and say, okay, no more, but we don't have to pay back the money collected so far. It's really up in the air, but it's very possible all the tariffs or a good portion of the tariffs that have been put in place since April. Let's take a look at the magnitude of what we're talking about here. So there's 159 billion that's been collected through the end of September. And it has to do with various tariffs on different countries. And it's possible that the Supreme Court could overturn some of these, like the ones that are fentanyl-linked tariffs, which is 36 billion, or they could overturn all of them. So even the reciprocal duties that were put in place. And if they do all of that, it's 159 billion of tax receipt, essentially, that goes away. And the administration's really been banking on that to pay for that tax cut package that was passed this year. So a lot rides on this Supreme Court case. And I'm not sure we're going to hear about it in the next month or two. I hope it happens sooner rather than later, because some clarity around tariffs would be nice, something we haven't had this year. But what happens if they rule against the tariffs and they get overturned? Frankly, prices will get a little friendlier. Some import costs are going to ease up, which is good. Businesses are going to get a little bit more breathing room because their costs are going to be more stable. Frankly, it might improve their profitability. And it's going to make planning easier for them, which has been very difficult this year because the tariffs would go on, then they'd go off, then they'd get adjusted and so on. And it made it very hard for them to plan their businesses. And the supply chain should smooth out because of this. We're not going to be guessing, is this going to be a tariff now? Is it going to be taken down? So that should smooth out the supply chain. Clearer rules going forward will provide more predictability, which is a big win for consumers and for businesses. And frankly, for markets. Markets appreciate stability. And once we know the rules, the surprises start to go away, we hope. So there's some good things that could happen from that, but it does create a little budgetary problem. And how are we going to pay for the tax cut packages? So a lot remains to be seen. I think this is one of the biggest news items between now and the first quarter economic update. And if something happens here, I'm almost positive I will release another video putting a little bit more detail around whatever the Supreme Court's decision is with tariffs. Okay, other big news. The penny has been discontinued. So they will no longer be minting pennies. And here's an interesting stat. It actually cost more than 3 cents to mint 1 penny. The penny just didn't have a chance, right? So moment of silence for pennies. Okay, I said I was going to talk about the Federal Reserve and their decision in December. I've already talked about that, and frankly, a little bit of a head fake because I don't really want to talk about the Fed. The Fed doesn't have enough data to really make a decision. And frankly, I think we've moved a little bit beyond the impact of the Fed on the markets. It will have an impact, but it's not going to have an impact like it had. There's one other thing that is going to be more important. So I'm going to X out the Fed interest rate slide that I tend to spend some time on, because what's going to matter more for the stock market, and that's going to be the rest of our discussion, is what happens with corporate earnings and profits, because that's what ultimately drives stock prices. Let me start with that data right away. What's going on with earnings growth, profit margins? You can see the chart on the right here. Profit margins have been very strong, really rebounded since the beginning of the pandemic. Profits have been strong among corporations, and their earnings growth has been strong as well. I want to take this chart here on the left and focus in on the current time frame, 25 through 2027. Let me zoom that in a little bit. 2025, we've seen earnings growth around 11% versus the prior year. And you can see in 2026 and 2027, expecting more healthy profit growth in the next couple of years. And so the stock market's always pricing this in. It's really just a pricing mechanism of what's expected of future earnings from these companies. Earnings are expected to be strong for the next couple of years, which might explain why we've seen such a strong stock market the last few years. But given that strong stock market, we're also seeing higher valuations. So let's take a look here at the current valuations versus the history since 1994. So you're really looking at 30 years of history here. The current forward PE on stocks, forward price earnings ratio, is 22.8. The average PE over the last 30 years has been 17.1. So that's the middle line on this particular chart. And once you get above the one standard deviation line of 20.4, you're really starting to have valuations a little bit more lofty. And history has said that often that forward PE ratio will come back down towards the average. But you can see it doesn't do it right away, and it doesn't really stay there. So this is just a guide of, hey, are stocks pricier than average, or are they a bargain right now? You can see in the Great Recession, 08, 09, stocks were an absolute bargain. You can see in 2020, very briefly, when the market pulled back, they were a bargain. You can see in 2022, there was a bear market that lasted about 10 months in 2022. Stocks were a bargain again, but you can also see that there have been periods of time when stock valuations have been high. You can see the dot-com era back in the late 90s, early 2000s, and we're flirting with similar levels right now. What would bring that line down? Obviously, if stock prices fell, that line would come down. Another way that line could come down is if earnings are expected to grow even more than they are on the slide that I just shared with you. We really don't know, but I will say at this level, we're more prone to react to bad economic data than we would be if we were near average valuations. There's one other thing that's really not new, but I want to put it into perspective for you, and it's the concentration of the stock market in earnings among just 10 different companies. So if you look at the top 10 companies, and I want to show the chart here on the right. So let me just zoom in on it. If you look at the top 10 companies, the market cap, those top 10 companies account for 41% of the S&P 500 index. So of the 500 stocks in that index, the size of the top 10 companies makes up 41% of the index. So the other 490 companies make up 59% of the index, which is pretty astounding. But you look at the earnings in those top 10, even though it's 41% of the market weight, it's 33% of the earnings of the S&P. And often those lines will be closer together than they are, which means that if history was to repeat itself, it's very possible those top 10 might pull back a little bit because their weight is larger than the earnings contribution. That might not happen, and it doesn't have to happen, because these top 10 companies are also the companies that are expected to benefit the most from AI, or most of them are going to benefit the most from AI. And there's a lot of excitement around AI and what it will be doing for corporations in the future. We're in a position where this concentration might work against us, and we need to pay attention to how it'll affect our portfolios. The first one is more concentration equals more sensitivity to bad news. So I just talked about that. Also, not only bad economic news, but potentially bad earnings news. So if earnings estimates start to come down, I think you'll see an outsized move with equities to adjust for that. The other 490 stocks look relatively normal from a valuation standpoint. So it's important, and we are doing this, that you have broad exposure across the portfolio, not just those top 10 companies. And we've always done that. But volatility can definitely spike faster, and stocks can be hit harder when you're in this period of concentration. So again, the key is just keep that portfolio diversified, which we are doing. It doesn't insulate us from the market fluctuation, but we don't want to get caught in the concentrated portfolio if there's a big pullback like we saw in the dot-com era, where a number of tech stocks dropped a lot more than 50%. So we just want to make sure we diversify among not only growth stocks, value stocks, but small, medium, large, and international, just to have our eggs in a lot of different baskets, not just those top 10, which of course we also do own. Now, the big question everybody has right now is about AI, and especially these AI companies. Are we in a tech stock or AI stock bubble, or are we really just seeing that whole industry about to take off, and we're watching the amazing launch of what that will do for us and our economy? Let's take a deeper dive, get a better understanding of where we are with AI. Everybody can understand this, so I'll move on. No, I'm just going to point out one data point. It's over here on the right, which just shows 10% of businesses right now are using AI to produce goods and services. We are in its infancy as far as being applied to businesses. So there is a lot of growth in the future for AI in business. And I see that even with our firm, we're using it in note-taking. And I mean, I can see the potential for it. It's not perfect, but I can see how it will get better and better as time goes on. And it does build efficiencies. But again, only 10% of corporations in general are even using AI in their business. The bigger impact is going to be this chart on the left, which is productivity. So let's take a look at this chart a little bit more closely. Productivity is one of the bigger drivers of GDP growth. It's part of that GDP formula. And you can see when the personal computer was invented back in 1981, what happened with productivity as we really got our mind around, hey, how can we use this effectively? And productivity really shot up. And then it peaked, and we really saw productivity start to pull back. And now here we are really in the infancy of AI. And the expectation is that AI is going to ramp up that profitability again, which means the economy will benefit greatly if we can get the promise of AI into business. It will help economic growth without a doubt. And so the question is, have we priced in too much of that potential with current stock prices? And it's hard to know at the moment. There are really 4 key signals to look at to see, hey, are we in an AI bubble or not? Number one, productivity hasn't moved yet. We're really at the early stages, as I mentioned, because adoption is still low. A lot of companies aren't even using it. So the valuations are high, but that's typical for early stage tech. If you think about, look at Amazon back in 1997, or Google back in 2004, or Apple before they created the iPhone. Valuations tend to be high, but the idea is you could see the future payoff. And so that's why there's so much interest and investment in AI, because it's transformational. And I do believe it will be. But the results really are going to hinge on the real world impact. And the jury is still out on that. If it improves productivity, great. There's been some false starts with it. I've seen some news stories in companies that used it for customer service and then decided it wasn't good enough, which is true. I use it quite a bit for just personal things, and I can see it makes errors and tends to hallucinate from time to time, but it has potential. It will get better, and I think it only gets better from here. A lot of that has been priced in, but if it starts to show that adoption and that productivity improvement, then you could make an argument that these valuations are fair. Okay, so some of you still might be a little bit nervous about the valuations and where stock prices are, and are convinced that we may be near a bubble. But let me put some perspective around this with this terribly busy, horrible slide, but I just want to pull out a couple of data points from it. The first is that the average expansion, which means a bull market or expansion of the economy, lasts for 49 months, and a recession average, it lasts for 14 months. However, that's data going back 100 years. If you look back to 1980 to now, the average expansion is probably closer to around 85 or 90 months, not 49 months. The business cycle has definitely gotten longer. We're at about 65, 66 months into this current expansion. So it's actually shorter than all of the expansions so far going back to 1980. But the other thing to keep in mind is that the expansions are a lot more rewarding than the recessions. If you look at bull markets, the average number of months in a bull market very closely matches what I just said. The average number of months is 70, and the average return, and I'm looking over here in the bottom right, is 221%. The average bear market lasts 14 months with a decline of 39%. Those are really good numbers for long-term investors, which is what you are, which is what we help you be. With your portfolios, we're always looking towards the long term. And so I know there's a lot of other things on this slide. Feel free to pause it and look through it. But I just wanted to point out the fact that, frankly, this expansion or this bull market that we're in really only started in 2022. And it's done pretty well since then. But most people don't believe in it, which makes me very comfortable when that's true. In fact, here's a data point that I am really excited about that I'll end this presentation on. Bad news is good news. The bad news is consumer confidence hit an all-time low in November, this month, 2025. It hit an all-time low. And people are just feeling more pessimistic and bad about the economy than they ever have before. And that's a really good sign for markets typically, because markets tend to do well when people don't feel great about them, and they tend to do less well or even poorly when everybody's exuberant about them. So there's a box in the upper left side of this chart that I think tells the story. So the S&P returns after the consumer confidence hits a new low. There's been 9 times that's happened. The average return 1 year out from that point for the S&P is 24%. At the peaks, and there are 10 on that slide I just showed you, the average return 12 months out from a peak is 3.9%. So I'd rather be where we are right now. When I see low consumer confidence, it gives me a very comfortable feeling for what the next 12 months might look like. As I've said before in this presentation, it's not going to be a smooth period over the next 12 months. There are a lot of things that are going to happen with tariffs, valuations, economic data that wasn't released, that will be released, that we won't fully understand or have confidence that we can use those numbers quite yet. So there will be a lot of noise, but long-term, nothing has changed with your plan. Diversification, rebalancing, blocking and tackling, all the fundamentals. We're doing that. We've been rewarded very well over the last few years. And even looking back over the last decade, we've lived through a couple of bear markets. The plans are working. Thank you for your attention. If you have any questions or comments, please email me. You can find that information on the YouTube page here, and we'll see you next quarter.